Westpac's Chief Economist, Luci Ellis, is the former Assistant Governor of the Reserve Bank and its Chief Economist. So I caught up with her late this week and just asked her straight out, will the RBA hike rates or not?
On the basis of the information we've seen so far, no, but there are scenarios where they end up doing so.
OK, what's that scenario where they end up doing so?
If they see a really ugly June quarter CPI and ongoing strength, stronger than expected labour market, then they might tilt in that direction, or at the very least end up not lowering rates until next year relative to our current call. We just don't think that's the most likely outcome at this stage. OK, so you do enormous modelling here at Westpac. You have access to enormous information about consumer behaviour. Given all of that, what does that next quarter's inflation number look like, and does that potentially prompt the Reserve Bank to raise interest rates? On the basis of our forecasts, we don't think that the June quarter is enough if it plays out as we expect to date. If, however, the June month and the June quarter turn out to be stronger than what we thought, and the other data that is relevant to the economic outlook are also stronger, then that might change the game. As the Deputy Governor mentioned in his recent speech, you don't make policy on the basis of one number. It would be a bad mistake to do that. OK, so the things that are rising in price rapidly right now, housing, particularly rents, insurance, health costs, education, you could see them all in that last quarterly number in particular. These are things that people can't avoid. These aren't discretionary inflationary items. Does that mean that inflation is now becoming embedded in our economy? We don't think it's becoming embedded. Services inflation is coming down. Some of the reasons why some of those non-discretionary items are seeing strong inflation in the recent past is because of indexation. So year one inflation is high, that then gets propagated to year two inflation in those items. As total inflation comes down, that effect does dissipate over time. Now, there's a good argument for not CPI indexing those prices and instead indexing them at 2.5%, the midpoint of the RBA's target band. That would avoid propagating those inflation dynamics in this way. But the reality is it's not causal, it's an effect.
So then take me to wages. Is wages having an inflationary effect on our economy right now?
Wages growth has already peaked. One of the downside surprises in recent economic data is that the Fair Work Commission announced a smaller increase this year than what a lot of people, including Westpac economics, were expecting. We put our forecast together on the basis of a Fair Work Commission decision somewhere in the 4 to 4.5% range. In the end, they've put through 3 3/4. And if you look at indicators like the wage price index, a lot of the wage bargaining system has already seen a rollover in wages growth. So that's not going to be a source of new inflation in the period ahead.
OK, then take me to the government's actions from July 1, the tax cuts that will come through, the cost of living relief that will come through. Is this inflationary? Is this going to add to inflation? Even though I know the energy initiative of the government, the $300, will actually take pressure off the headline rate of inflation at least.
Well, let's start with those rebates. Yes, energy inflation will appear lower as a consequence of those rebates. That's the way the ABS measures these things. And of course, that's exactly why everybody got the rebate, to ensure that it actually reduced measured inflation. That will have the effect of helping anchor inflation expectations, which is something that the RBA worries about. And as I already mentioned, this indexation issue, even if you're artificially bringing down headline inflation this year, that does mean you have less indexation of those administered prices next year. And that does help at the margin. What a lot of people are worried about, though, is whether you have a bit more demand because you've got more money in people's pockets. OK, $75 a quarter might not seem a lot to some people, but it will be a bit to some other people. But what are they going to be spending it on Well, they're already spending a lot on the non-discretionary items where the inflation is. They're going to be spending it at the margin on the discretionary things they've had to pull back on. And that's where inflation's currently low. So I think that's another moderating force. We do have to acknowledge that extra money in people's pockets does add a bit to demand, but there are all these things on the other side that you've also got to weigh up. And I think the Reserve Bank's aware of that. Now, the other point that we need to bear in mind is the tax cuts. They're much bigger.
They're big, yeah.
But the thing is, everyone already knew about them. They were already in everybody's forecasts. And in fact, without the tax cuts, you're not going to see any recovery in consumption growth. Household consumption growth has been really weak. And without those tax cuts, household income growth would be really weak and consumption would stay weak. And so everybody's forecasts already had baked in those tax cuts. And yes, they were tweaked a little bit back in January, but they were tweaked in such a way that they didn't change that overall effect on demand and therefore on the outlook for inflation.
Okay, and it is acknowledged that the path that the Reserve Bank is on, and that the government is on as well, and that is to try and allow inflation to taper off over time while trying to maintain as many jobs as they possibly can, that this is something that has never been really successfully tried in any major economy. Is it likely, in your opinion, that this strategy could work here in Australia?
I actually think modern central banking absolutely makes that trade-off between getting inflation back to target over a reasonable time and ensuring that you don't lose the gains on employment. Where Australia is a little bit different this time around relative to some other countries is we've managed to get unemployment even lower than what we saw just before the pandemic. In other countries, unemployment's low, but it's roughly where it was in 2019, broadly speaking. They all got their unemployment rates down to multi-decade lows in that late teens period, and so they know they can do it again. Whereas in Australia, we didn't manage that in the late teens. We still had unemployment hovering around 5, whereas now, it's only just got back to 4 after being below. And so I think part of the story is that the Reserve Bank acknowledges that the rate of unemployment that's sustainable while keeping inflation steady isn't itself constant. It has come down and they're acting on that basis. So I don't think this is an untried experiment at all.
Okay, I'm going to finish where I started, and that is on interest rates. You say that maybe there's not a rise coming, so when's the first cut going to be?
On the basis of the information we have to date, we've penciled in the first cut in November, but we don't think they're going to be in a hurry and we don't think they'll be cutting quickly from there. It will be a very measured pace once it starts.
Luci Ellis, great to chat to you as always. Many thanks for your time.
Thanks, Ross.